Hello, everyone. I'm Andrew Reed, Juris Doctor, Small Business Development, IT, and Marketing Guru from sunny Victoria, BC. Follow me for new podcasts on beginner investing in business as I survive, grow, and prosper in a post-COVID Canada. Disclaimer: my podcast and YouTube content offer very generalized information that has been beneficial to me. Always do your homework and due diligence and make sure that any moves you make are in your own best interest. Nothing in my content is any kind of advice, and continuing to listen constitutes acceptance of this disclaimer in its entirety. Welcome, everyone, to the 7th episode of my 10-part wealth hack series. And we'll just go ahead and dive right in to number 61. Support your holdings. For example, if you own Amazon stock, shop at Amazon, shop at Whole Foods. Use Alexa as your smart home system. Be an Amazon Prime subscriber. If you don't like their products, then maybe it's time to reconsider why you are investing with them. If you own Cineplex or Dollarama, well, I think you get the point. Sneak in some Dollarama candy to your next movie date. Number 62. If you don't have anything better for this already, at least, for easy tracking of stocks in 15-minute intervals, you can use the Google Finance app. It has a great watch list feature, and it shows your biggest movers on the home screen. It also collects and links news articles related to your holdings. And it doesn't really do crypto, so for cryptos, I like the Crypto app. Available on Google Play, probably in the Apple Store too. Has real-time tracking, programmable warnings of major up and down movements, and it's a good cultivation of crypto news. Also, I'm just going to add to this Yahoo Finance, which has some great detailed financials information for most stocks. That being said, if you're using something like TD Bank or one of the major banks where you're paying for commissions, those will usually include real-time stock tracking information. So this is only if you're using something that's commission-free, like Wealthsimple, and you just need a little bit more detailed information than something like Wealthsimple could provide. Number 63, investing.com. So at investing.com, if you go to indices futures, it's a little tab there, you can actually get a sense of where the stock market is going to head the next day. And so credit goes to Meet Kevin for this tip. He's the one that presented this. But this is where you see futures. So seeing what everyone else thinks of the future with their money can help you prepare your investments for the next day. So if futures are up, then there's a good chance of a bull market the next day, perhaps a mini bull market, or at least some kind of rally. If futures are down, then there's a good chance that things could travel in the wrong direction. This isn't a guarantee. I mean, sometimes this goes wrong, but it at least gives you a little bit more insight into what's going to happen the next day. Number 65, mind the consequences. So this viewpoint, this perspective, has been embedded into my personal decision-making since law school. And I would describe it as visualizing the chain of possible consequences to the choice at hand. I'm referring to the natural chain of consequences as you're generally separated from consequences where an unforeseeable intervening act causes the consequence. And without that act, the consequence would not have occurred. I know that sounds complicated, and there's exceptions to such generalizations. But let me try to illustrate it with an example. If you're sweeping off your deck and you live on the 7th floor, like I do, then it could be foreseeable as a natural consequence. If I'm sweeping stuff off the deck, like little rocks or something, and they fall and they cause somebody an injury, they get hit in the head, this is a consequence that I could be and should be held responsible for. So because I could foresee this chain of consequences, this causal chain, I could sweep those rocks into a dustpan, avoiding the potential consequences by breaking that causal chain. Therefore, if a gust of wind takes that dustpan and flips it around and it bounces off the neighbor's porch and then goes down and causes a car accident, that is beyond the natural consequences of me sweeping the porch. So I would no longer be responsible. Another example, you're driving and you change the radio station and you're looking down uh, at the radio itself, and you look up and you're halfway into the left lane with oncoming traffic. And this causes an oncoming driver to swerve slightly. That's foreseeable. But they lose traction, they spin out, which is fine. The car behind them slams on the brakes, the airbag deploys, and that driver dies. Um, all of that's kind of foreseeable, even though it's unusual series of events, but it's foreseeable, and then all of which you're responsible for. Um, but say the driver behind you sees the accident and they overreact due to being distracted a little bit themselves. They lose traction. They suffer permanent injuries from the resultant 5-car pileup that they create. Well, then you basically have another independent cause for the accident. It's an intervening event. Now, the nuances on these get really complicated, and lawyers are trained to argue in either direction, depending on what they're attempting to prove. But my point is, the overreaction was not really a foreseeable consequence. So you can't try not to overstress about causal chains that have unforeseeable events. You can't predict all that, and it could drive you crazy. It might have driven me crazy already. All I'm saying in a non-advisory way is try to predict the natural consequences of your acts and then choose your risks very carefully. Number 66, treat yourself on occasion, but do it as a reward. Train yourself like a dog. Reward achievement and accomplishment. The bigger the achievement, the bigger the reward. The future is not guaranteed, so hedge your bets by getting a little enjoyment out of life, rationed out as positive reinforcement. Number 67. Be wary of service providers. Healthcare, for example, a dentist. A dentist is generally motivated primarily to generate revenue for themselves. They may absolutely love their job. That's irrelevant. This doesn't change the purpose of society to maximize wealth, to maximize individual prosperity. So therefore, that dentist will upsell. They'll accelerate timings on treatments. So be sure to ask questions. Do a full risk benefit analysis of every service offered, and be mindful and wary of additional charges. Get a second opinion where appropriate. Not just for healthcare, though. This is any situation where you are dealing with any people or places that are revenue motivated. Mechanics, car maintenance, optometrists. Look for revenue motivation and protect yourself. Number 68. Be wary of so-called financial advisors. In Canada, there are ways to use that description without necessarily going through gatekeeper agencies, and I don't really put much stock in gatekeeper agencies. That's just something to consider. So ask yourself this question: why do you feel your financial advisor is worth paying your hard-earned money to? Very few investors can stock pick individual stocks or funds and beat the S&P 500. Sure, there's a lot of temporary exceptions. Um, but if you're listening to this during the great crash of 2022, which we're in right now, you're probably way down right now. Here's the thing. I mean, investments go up and down in value, and if the fundamentals are still strong, then the investment should go back up when the macroeconomic environment goes back up. Timeline doesn't end right now. So can a chart reader, a technical analysis person, a financial advisor predict better than your own personal due diligence in your investments into a diversified portfolio? For example, could you just invest into a full S&P 500 ETF like Vanguard's VFY, with its average of 10% returns if dividends are reinvested, and beat most financial advisors. I mean, you have to make that call yourself. You have to make that choice. Statistics show that most advisors and funds do not beat the S&P 500 as a whole. And therefore, if it's just educated guessing that you're paying these guys to do, you really need to pay those steep fees for risk that may be no different from your own well thought out choices. Again, your choice. But I personally choose to avoid as many fees as I can. As you guys know, that's why I use Wealth Simple Bank for stock and crypto trading, because there's no stock trade commission fees, there's no minimum balance, you can do fractional trading and tons of other features. So if you're interested, you can sign up and try it from the link in the description. If you do that, you'll get the cash value of 2 random stocks, and I'll get the cash value of 1 random stock. And I'll feel overjoyed that this podcast has provided a tiny cash flow, and it will justify all the hours that I spend on this. In the final wealth hack for today, number 70, you will take some losses. The big L, you'll take some L's, and you should take some losses. You have to measure potential losses against potential gains. Here's an example for you. Meet Kevin sold his entire stock portfolio in the first quarter of this year at a loss. And he did this because those sales boosted his capital gains losses, which could be applied at tax time to offset his capital gains, thereby reducing the amount of taxes that he's paid. And so think of the following cost-benefit analysis that he applied. So stock is about to drop 30%. It's right now at 10% down. Okay, but he's predicting that over next period of time, it's going to drop a full 30%. So if he sells now and then at 10% and he buys again when it's 30% down, then he's technically avoided 20% of potential realized loss. So what's the catch, right? Because the catch is, Kevin didn't know, he doesn't know if and how far the stock will drop in price. So one can only make their best attempt to economically divine the future. Now, Kevin has a vast knowledge of economics, and he stays very well in tune with what is going on, which is why I recommend watching him, even though he's an American. And I believe that the more awareness and knowledge and experience one has gives some advantages in many ways. There's still no knowing of the outcome, but it seems like, at least in this example, and it's too soon to truly judge, but Meet Kevin's assessments and decisions seem to have worked out well for him so far. So, as you can see, my point, losses can be used intentionally and strategically to mitigate a bigger loss. So concludes my podcast for today, Wealth Hacks number 61 through 70. Stay tuned. I know these are coming a little less frequently. It's just a busy time of year, but I will keep them coming, so please check back. And we've got 3 more in this Wealth Hack series to go. So stay tuned, and best of luck investing.
Instagrams you would like to share with us before you go?
Get the latest real-time updates from my Instagram at Canada Stock Market. At Canada Stock Market. Check out my entire catalog of podcasts completely free at anchor.fm/Canada Stock Market. Anchor.fm/Canada Stock Market.